We're at 9:04, almost 9 o'clock Eastern. This is your last chance to mute your favorite platinums to the call. Limited amount of seats here, so we only have 100 seats, so we have half seats at capacity. We're at 50 seats. This call is reserved only for platinums of the My $20 business. So congratulations for being here. Congratulations for making a great decision. And we're just happy to have you on the call here today. Okay, and I have the chat box open throughout the presentation. So if you want to ask questions, you can do it through the chat. I'm going to be muting out the lines here in just a moment. Hey everyone, Bill Constain here. And this is your Platinum webinar. It is April 1st, and this call is not for fools. This is for the wise. These are for the people that came on, became Platinum, a great company. Before I go into the webinar, I just want to recognize we have Steve Gresham, the CEO of My $20 Business, and has been the CEO for Savings Highway for the last 14 years. For those that are receiving a weekly check, you'll notice that it comes from Savings Highway. That's our parent company. My $20 Business is in pre-launch, and it's been in pre-launch for about 10 months. And we're putting everything together. It's an opportunity, as you know, because you're all platinums on the call, that provides savings for the average family, saving about $5,000 a year. And you can come in for as little as $20. You get all the benefits with this program. In an economy like we have today that is just struggling, stumbling, going into recession, and maybe even in risk of going into depression, doesn't it make sense to save money? Doesn't it make sense to do online shopping from the convenience and from the safety of your own home? That's the opportunity we have. All the big box stores, being able to participate, getting savings and cash back. But I don't have to tell you because you guys are members already. But they say that the mother of all skills is repetition. So I'm repeating it a little bit for you also to reassure and endorse that you're in the right place at the right time. I've got over 30 years experience in the home-based business, but I also have over 25 years in the financial services business. I own a financial company, and one of the main things I teach people to do is they must have a home-based business. Average family saves about $500 to $1,000 on their taxes. So when you couple $500 a month, that's $6,000 a year, let's say, and another $5,000 a year with our savings, that's roughly $10,000, $11,000 a year coming back to your family. That's increasing your cash flow. A lot of people are in debt. Maybe some of you or many of you are also in debt. Well, our mission, along with Steve Gresham as the leader of the company and our incredible advisory board with Kenneth Reed, Cornell Jones, and Tim Jones, along with myself and my wife, Nicole, we have a joint mission to help 1 million plus families get out of debt and experience financial freedom. Because as you're getting out of debt, doesn't it make sense that you have to save money someplace? So we want to help people increase their cash flow, get out of debt. We have that opportunity with a home-based business. We have that opportunity with My $20 Business because you're saving money, not only on your taxes because you have an intention to make a profit, but you're also using the service. You're using the product. That's the key. You're actually going in and saving money on so many categories, from your auto insurance to groceries to your online shopping, buying cars, selling houses, whatever it is. Just I encourage you to go in and experience the service. You may be a member for a week or for a month or for the last 10 months since we've gotten started. Just ask yourself a question. Have you used the service as much as you should have? Be a testimonial. Be your number one best customer. And we would love to receive your testimony. Okay? So that will encourage other people to join your business when you're saving money, increasing cash flow. So here we are. I decided to join in as a partner, advisory board member, and I'm here to help you. My wife, Nicole, and I have made millions in the industry. We don't say that to impress you. We say that to impress upon you that of all the opportunities out there, we've chosen your company, the My $20 business, fondly known as the My $20 travel business, My $20 savings business, and many other great names, Savings Highway. So Steve has asked me to do a platinum call here today, and it is my honor to do so. So I'm going to take you through some slides. I want to encourage you to stay through the entire webinar because I have some gifts for you and your family, but you have to stay on the whole way to get those gifts. Those gifts could be literally worth thousands and thousands of dollars. So please don't make the mistake of leaving this webinar early, okay? So make sure the door is shut, make sure you don't have any distraction, and let's get this thing going. How to escape the retirement tax trap, right? Because at the end of the day, we want to create income so that income, that money, can be our employee. So if the government's having a little shutdown or there's having a virus that's out there, it's affecting the economy, you have money that's guaranteed to pay you for the rest of your life. That's why I also love this home-based business, because people are searching and looking for a home-based business, an opportunity to save and make money from the comfort and safety of their home. So now I'm going to show you what to do with the money, because now that you've found money, because you are saving money on taxes, your cash flow is improving, you're getting cash back when you're shopping, you're saving money, hopefully an average about $5,000 a year, another $5,000 or so on your taxes. That's $10,000 a year. We're going to look at some ways. We're going to compare and contrast. And then you can actually comment in the chat as well. And this will be recorded for you to review. And you'll have a special handout at the end only for Platinums. Okay, so here I am, Bill Constain, wealth strategist, CEO of Freedom Wealth Services for 25 years. I started on Wall Street and then became a financial planner. And then I've helped advisors all around the country. I was on the advisory board for a company called Money Tracks, where I helped teach and train over 5,000 advisors. I have clients all throughout the country, and I have advisors that plug into my technology. So I hope this information serves you well. So here we go. This information here is presented by a licensed professional, me, and not specific to any individual personal circumstances, to the extent that this material concerns tax matters, etc. You see the disclaimer. This presentation provided for general information, and hopefully it will serve you. So you can get back to someone who's an expert in this area. We also invite you to get back to us directly because we're the ones that provide the information. There's my immediate team. You know, we have hundreds that plug into our team, but that's my core team. My wife, Nicole, of 20 years, and my partner, Daniel Nicolaescu, who's also a proud member of the My $20 business, and I know he's on this call right now as well. That's where we were doing actually an event local in the St. Augustine, Florida area. Okay, so tonight's agenda, 3 biggest risks during your retirement. Common retirement vehicles and the #1 tax minimization retirement vehicle. Maybe even a vehicle where you could eliminate taxes legally and ethically. Wouldn't that be great? Income category. Now, we're talking about strategies that the wealthy. Now, the top 25% are usually considered the wealthy. So income, an educated guess, what do we think the top 25%, what would be the minimum income? What do you think? I mean, you can put it in the chat there, the top 10%, the top 5, the top 1, and then we have statistical data from the IRS. The top 25%, a lot of people say, well, it's got to be at least $100,000, at least 25%. Top 10%, people say, well, it's got to be $250,000, at least in the United States. 5%, $500,000, and the top 1% has to be making at least $1 million. Wouldn't it be nice to be making that type of money and more residually repeat income from the My $20 business? Well, I'm here to tell you it's not only possible, but it's going to happen. Question is, will it happen for you? So many of you have other businesses and you might be making this type of income elsewhere. But what really is the top 25%? Because the top percentage of people, they're also paying the most in taxes. So top 25%, according to the IRS, is actually top 1, is 480, top 5, 197, top 10, 139, and top 25, just under 81,000. So as you look at that, maybe you're actually in these top brackets and you didn't even realize it. But the key here is, what do we do when it comes to taxes? Well, we have different saving solutions, different investments. Now that you have money, or now that you strive towards having money, where are you going to put it? Well, there's three major buckets: taxable, tax deferred, and tax free. Which one of those colors look better to you, the red, the blue, or the green? Well, if it's taxable, you might be in cash, of course, in your bank. If you have cash under your mattress, then you're probably not paying tax on that. But checking, savings, CD, stocks, also mutual funds in a taxable environment. Bonds also can be taxable as well. Tax deferred, 401ks, IRAs, 403, and they come in many different flavors. SEP, simple IRAs, etc. Savings bonds. And then you have tax-free. You have the municipal bonds. Well, those have some interesting tags as well, and the interest is not very good on municipal bonds and not very guaranteed. 529 plans, college plans for the kids. Only challenge there, of course, is it's specifically for college. So if your kids don't go to college, then what are you going to do with that money? Maybe you're going to give it away to a nephew or a niece. You don't have the freedom to put that money where you want. How about a Roth IRA? That's been extremely popular. You pay taxes on the money up front, but you let that money grow tax deferred, eventually have that grow tax free. We're going to be talking to you a little later in this webinar about something that we call a super Roth IRA. So all the great benefits of a Roth IRA, but without the government strings and the opportunity to have some additional benefits. I'm just going to put that as a little mystery for the rest of this webinar, right? You could circle that if you want. Three biggest risks during your retirement. Okay? And I know for some of you, you're in retirement already. And for others, it's a long ways away. Volatility of the stock market. That's what we're experiencing right now. What I call the Wall Street roller coaster. Anyone on the call, on this webinar, starting to feel the aches and pains, maybe a stomach ache of the Wall Street roller coaster? You just don't know when to get off. You just don't know when to get on. It's just a little rocky. Of course, the rules for accumulation and the rules for distribution are completely different on how we look at money. The risk of the 20s and 30s, we can take that risk because we feel we can make that money back. But as we enter our 50s, 60s, 70s, maybe we don't have the same risk outlook. Longevity. Biggest fear that people have is actually outliving their money. And of course, taxes. You could save money your entire life, but if you're saving in vehicles where the tax brackets are unknown and you have this money in a 401k or an IRA, you just don't know how much of it is yours and how much of it is our favorite uncle and aunt. And you know who that uncle and aunt is. It's Uncle Sam and Aunt Iris. That was my first joke of the night. Hope you enjoyed that. Uncle Sam and Aunt Iris, they're very interested in your money. They're your partner in your financial plan if you plan it their way. All right, so stock market volatility, invest $100,000 in the market. That's good. You lose 30% the first year. The market goes down 30%. You're at 70,000 now. How do you feel? You have to gain 42.8% the next year just to break even. So, well, wait a second. How about if I just make 30%? Well, it doesn't work like that because if you're at 70,000 and you gain 30%, you're actually only gain 21,000. You're only back to 91,000. You've got to gain 42.8 to break even. Bears and bull markets. Mostly we see the green, which is a bull market. Mostly the market goes much higher. But if you catch it at the wrong time, it can be very, very painful. You can see back in the 1920s here, the Great Depression, 2.8 years, down 83, down 47. And then we had this booming time. And then we had this negative 21. And then we had a booming time. Right now, we are in a bear market. We're starting to get into a bear market. We've had an 11-year run of green, green, green. What happens in the future? Things are changing. That's the reason why Steve Gresham said, Bill, we need some financial literacy. we need some financial education. So here we are. We have mostly bull markets, very few bear markets, but they do come. And when they come, they can wipe out gains very, very quickly. Stock market 2000 to 2018, a 19-year run, okay? That's taking it through some tough times and an incredible decade. So there you are at 100,000, and the market is going up. But what's the rate of return? 4.37%. Okay. 4.37%, is that good? Well, most people would think they would have done a lot better. That's not even including what? You have to take into account management fees, inflation. How about taxes? So all this excitement and the health that we sacrifice watching the TV, trying to make these gains, and it's Wall Street that's making the money, charging the fees, and it's IRS that's charging the taxes. And what are you left with? What are you left with? Quite often, nothing, and maybe even losses. So that's the grim potential of being on that Wall Street roller coaster. Okay, so this is Mount Everest. More than 4,000 people have scaled Mount Everest, and over 290 people have died. They help you make it to the bottom safely. But most of those people have died on the way down, okay, because they didn't have the exact strategy. So you can make that money in the market, but how do you get down from the market and take the money from your accounts? Your length of retirement, average length of retirement is 20 years. So the average life expectancy, if you're currently 65, or when you get to 65 in pretty good health, you have a good chance of getting to 85 or 88. A lot of people live into their 90s. Clients are even living to 100 and beyond, and that's today. Maybe 20 years from now, 30 years from now, 100 will be 120 with medical advancements. You want to make sure that you are not outliving your money, okay? You don't want to be that person out there looking for a job at 95. Again, a plug to have a home-based business, because as long as you have a home-based business, my $20 business, and you have a residual, reliable check that comes in, that's financial freedom. So there's that plug again, that reassurance that you're doing the right thing. But along the way, you must save. Okay, well, outliving your income, that's the thing. See, it's the race to see, will you outlive your income? And that's stressful. I know a lot of financial planners that mean well, and you may know some of these as well. They'll show you a financial plan that shows you taking money out till 80 or 85. And I always say, why do you stop taking money at 85? I say, well, that's mortality. I don't need to show anymore. And I think that is irresponsible. I think that, in my opinion, is financial malpractice. I want to see my money going out to 100 and beyond and feel safe about it. Don't you? 50% probability in a lot of these cases that money runs out at 90, and 5% probability. So plan accordingly up to age 100. Effects of 3% inflation, right? So we could factor everything in, but inflation is something that can be insidious in the financial world, which just makes things more expensive, makes your dollars less valuable. So 2019, this Audi is $50,000. That same vehicle with a 3% inflation is $67,196. And in 2039, that same exact vehicle is $90,306. The same thing can apply to everything that we buy. Long-term care, thinking big picture, right? Providing value and understanding there's three major contingencies, three major things that we want to protect. Number one, if we die early, God forbid we die early and we have loved ones that are relying on our income. Do we have an income replacement strategy that if something were to happen to you, that your family would be able to stay at least in the home, the apartment, the lifestyle that you intended for them as the leader of that household? Or would they have to sell everything? Would they have to scramble? So that's having the right income replacement. You have to protect against early death. That's at the core financial plan. Replacing income. Let's make sure our families are taken care of. Let's make sure we're being responsible. number one. Number two, what about disability? That can be even more expensive. Why? Because we're still here. We still have to eat. We're still consuming. Maybe we're not able to work and produce, but we still have to pay for care and consumption, disability. The third is long-term care is another significant factor with longevity. So we want to make sure these three areas are taken care of. What are the odds? Odds of a fire, 1 in 1,200, God forbid. Odds of a car accident, 1 in 240. Odds of a long-term care in the United States, 1 in 2. So do we have car insurance? Do we have home insurance for our houses? Do we have long-term care insurance? Long-term care insurance is such a big need for it that people were buying it like crazy and using it. Companies have come out of the long-term care business. There's only a couple of providers now that will even give you long-term care insurance, and it's very expensive. There are some programs now that you can get that include something that resembles long-term care. It gives you money that if something should have happened, 1 in 2, that you have money that can take care of that, so your spouse and your loved ones wouldn't be affected. We want to be as responsible as possible. The average annual cost today of nursing homes, $84,589, and in 10 years it'll be $113,680. Are we taking the right precautions for disability, for early death, for long-term care? Those are the three big doozies that can impact our family. Could you imagine your family having to move out of their house, go into something much smaller, maybe in a bad neighborhood, sell the car, sell the house, just because of an untimely death, disability, long-term care? There are simple things we can do to ensure that that doesn't happen. All right, again, 3 biggest risks during your retirement. And here we are, those numbers again. This is the percentage, 37% of the tax revenue to the IRS are from the top 1%. Of the top 5%, it's 58%. Top 10%, 70% all revenue. So they're very focused on these top people, the 86%. So the top 25%, if you're making 80,000, 81,000 and up, you're in that 86% of all IRS tax revenue. They're very, very interested in your retirement money, extremely interested. There's our U.S. debt clock. It's even higher now. It goes up every day. It's 22 trillion. You probably heard about that $2 trillion bailout here in the United States. Actually can go as high as 6.2 trillion. The numbers I've seen is over 80 trillion, 80, when you factor in future obligations like Medicare, Medicaid, Social Security. This is serious, guys. So are we going to partner up with a government here that is managing their money like this? The arrows all point to higher taxes in the future. They've got to get these dollars back. We have to be smart. We have to make prudent decisions that protect our family, that have a reduce risk, reduce taxes, reduce fees, and higher guarantees and higher income for our families. U.S. national debt per citizen, 67,000. Debt per taxpayer, 180,000. Crazy numbers, going up and up. There's this. You have to be very interested in the history of our tax rates. We put this together. I actually wrote an ebook that actually goes over all of this, and we can make that available to you as well. 1913, we started income taxes in this country. Many of you might know, or some of you may know, that a private meeting was held in Jekyll Island off the coast of Georgia. That's factual. The Rothschilds, the Rockefellers, the Mellons, all the major bankers. There's a book called The Creature from Jekyll Island. That's about a 600 or 700 page book. But it happened, guys. So from 1776 to 1912, there was no income tax in this country. 1913, we started with 1%. Okay, we started as a temporary tax. And it wasn't that temporary. So what happened here is once the IRS, there's our favorite uncle and our favorite aunt. Actually, I'm being facetious and sarcastic. It's probably our least favorite aunt and uncle. Once they realize, hey, they can get away with taxes. And remember, didn't we leave Great Britain, England, because we didn't want to pay taxes on our tea? Now we're paying taxes on everything. Well, different generation, right? Lost memory, and here we are. And all of a sudden, World War I was here, and we had to be patriotic, and let's chip in for the country. And we went all the way to the high 70s from 1%. And it was a little too much. Shortly after, we went into the Great Depression. People lost jobs. People on Wall Street were jumping out of windows. And worse, people committing suicide at a very high rate. Couldn't pay the bills. People losing their homes, families. And what happened? They brought the taxes down because they couldn't tax people when they were losing their jobs. So this area kind of looking a little bit like this over here because people losing their jobs. But what happened shortly after when they started working again? Taxes went up. There's Aunt Iris and Uncle Sam said, well, you're working, you're thriving, you have your house, you have your car, so we could start charging you more tax. And then here we are for a long period of time in the 80s and the 90s on the high bracket. And then here's that roller coaster. Remember, there was the Wall Street roller coaster, and now you have the tax, the income tax roller coaster. This is a tough roller coaster. So here we are, and I believe that taxes are on sale again. We're getting bailouts. We're getting forbearance for our mortgages. We're getting, we're getting checks in the mail. We're getting, all this stuff. We're getting quantitative easing, printing of money at the banks. What do you think is going to happen when people start thriving again? Here's the historic proof. Great Depression, people started to go back to work again, and look at those taxes go up again. What do you think? Do you think we're just going to keep going down in tax, or at some point, the Federal Reserve, the IRS, Uncle Sam and Aunt Iris are going to say, you guys are doing well again. It's time for you to pay up again. Excuse me. All right, so I hope you enjoyed that little slide. The average high bracket, 57.5. Right now we're at 37. So in historic terms, we are low. We are very low compared to where we are. So 57.5. Let's say you had a 401k or an IRA, future tax bracket, and you had $1 million. If you were at the high bracket at 37%, excuse me, talking too much today. If you were at 57%, you wouldn't have $1 million. 57% of that would be the Federal Reserve. You'd have 42.5, 425,000. Type of thing that makes you think. Where do you think tax rates are going? The three biggest tax deductions: mortgage interest, child exemptions, qualified contributions. We have those when we're in the working years, when we're younger. When we're older, maybe in our 60s and 70s, maybe you paid off your house. You don't have the mortgage interest deduction. The children are out of the house. You don't have that deduction. You're not participating in a qualified plan anymore, so you don't have those deductions. Let me ask you another question. When you have a day off, or if you have a week off and you're on, remember the word vacation, do you tend to spend more money when you have time off, or do you spend more money when you are working? Most people spend more money when they're on vacation, right? Because they're out, restaurants, remember restaurants? All that and eventually will come back. Restaurants, travel, all the good stuff. But my point is, when you're older and you're retired, quite often we spend more money than we think because we have all this free time, but we don't have the deductions. So we may be in a higher tax bracket than we believe. All right, so here's that 401k I was talking to you about. Remember that $1 million 401k? I know many of you'd like to have one. But if we're in a 30% tax bracket, your portion's $700, the government's $300,000. But if we're at 50%, that's your 50% partner. Okay, so now what? The perfect retirement vehicle, what you want. Preferably, we would like no risk. We would love guarantees. Who likes penalties? We don't like penalties. Liquidity, use, and control. Yes, we want liquidity, use, and control. We want it protected from lawsuit. We want leverage to be able to use it for business, for real estate. Tax deferred, meaning we don't pay taxes along the way. Tax free. Eventually, when we take the money out, we'd love to have that come out tax free. We would love that. Collateral to be able to use it against business again. Now, real estate, tax deductible payments, we'd love to get a tax deduction. Disability benefit, if something were to happen, to have the savings or investment, to have that continue to pay, we would love it. Wealth transfers, when you pass away, that money goes tax-free to your family. We would love all that. So let's examine the IRA. The red is exactly the opposite. You have risk. You have no guarantees. You have penalties. Maybe you have liquidity with loan or surrender. It's not protected. There is no leverage. It is tax deferred, but you don't get your money tax-free and so on. And then you could see how this all breaks out between mutual funds, your home, CDs, annuities. Annuities can be good. I like annuities, especially for retired people. People have guaranteed income, so that can be good. Real estate can be good. I do think that real estate's about to come down, in my humble opinion. If people are stumbling, that's the other thing with 401ks. If people are losing jobs at a rapid pace, of course, for a home-based business, that's going to be great for a home-based business because they need to start making money from the comfort and safety of their own home. They got to create residual income. They have to do it. And even if you still have your job, that's a blessing. How far or how long will it be that maybe that job will be gone? So that home-based business is so vital. Is there another category that can give us more of the green? That's the question. And the answer is yes. It's an unknown. And this is when it's properly structured. You might be shocked when you see it. Don't prejudge it. Just know it has to be structured properly, and that is life insurance. Life insurance is the number one tax minimization retirement vehicle, but it must be structured properly. Most people do not know how to structure it. They're just buying it for the death benefit. They're not buying it for the living benefits. So again, stay for the duration of the webinar. Now that you see life insurance, understand it's a very specific type of life insurance, which I'll explain. A unique combination of 3 tax benefits: tax-free death benefit, which is great. We want to protect our loved ones, right? If something were to happen and you were to pass away early and you just saved a couple $1,000s in a 401k, is that all you're going to give your family, a couple $1,000s in a 401k or a CD? You should have secured the right amount of life insurance, which would give you the income protection, which we discussed, especially in times like this. 2, tax-deferred cash value and accumulation potential. The money grows within the policy, protected. Tax-deferred, meaning you don't pay taxes every year. And then ultimately, when you take the money out, it comes out tax-free in the form of tax-free loans and withdrawals. But the big objection people will give me is, hey, I saw this on TV. It has high fees. The rates of returns are low. I can't get access to my money. I know it has hidden costs. Well, the truth is, when it's structured properly, and again, 99% of the advisors and agents in my industry, they don't know how to do this. You have to go to an expert. If you have an advisor, or if you are an advisor and you know how to structure it properly, go back to that person and say, hey, I saw a webinar and I need to structure something properly. But if you don't, make sure you contact us and we will set you up with an advisor that knows how to do this for you. And for some of you, you might even be able to speak to me directly because you're a platinum member and you're referred by Steve Gresham, and he's going to give you a good endorsement. Life insurance, wealth strategy. Top 25%, they know about it. This other 75%, they're mostly they're ill-informed. They don't know how to leverage it. 86% of the tax revenue, and by doing this properly, they're able to preserve those dollars and not give it away to Uncle Sam and Aunt Iris. Keep it within the family to create a family legacy. Protect, preserve, and then leave behind a legacy for their family. Sound good? Well, there's Susie Armand. She doesn't agree with me. She thinks you should have term and invest the difference in mutual funds and 401ks. But the issue is we don't know what the tax bracket's going to be, Susie, when we take the money out of the 401k. I just went over that information. So she gives general information to get out of debt, which is fine, and I respect that. But you can't make a blanket statement when you don't know all the facts. Unique combination of 3 tax benefits: tax-free death benefit, tax-deferred cash value accumulation, and tax-free loans and withdrawals. Yes, yes, and yes. All the green boxes. And as I always said, I don't care what it's called. I care about what it does. You know how many people prejudge network marketing? or a home-based business, they prejudge it. They don't understand. You understand. The same thing with life insurance. They don't understand because this is very specific. So what we do is something called an indexed universal life policy. You have a tax-free death benefit, tax-deferred cash value, accumulation, tax-free loan and withdrawals. Number one, death benefit should be the main reason you should buy life insurance. I would tell you that I have many clients that are not married, never had kids, and what we do is we structure a policy with the minimum amount of death benefit, and the maximum amount of cash value. They're not even focused on death benefit. They just want to focus on tax-free pension. So if that interests you, tax-free pension, let us know. I'll have my email and phone number. You'll just contact us and let us know what part of this presentation you're interested in. In the event of an early death, this benefit passes to beneficiaries income tax-free and can be used for income replacement, supplemental college funding, business success planning, right? So if you have partners in a business, God forbid you pass away early, does that business die along with the main person that knows how to run that business? You have to have a succession plan, mortgage, other debts, make sure that house is paid for, estate tax coverage for people that are super wealthy, and other financial needs. Did you know that banks have billions of dollars of life insurance? They have so much of it. They have departments called BOLI, bank-owned life insurance. The major corporations, the top 500 corporations, they have a separate department called COLI, C-O-L-I, called company-owned life insurance. They actually have high-level employees. Their job is to acquire life insurance for the company and for the banks. Tax-deferred accumulation. Your policy's cash value has the potential to grow income tax deferred based on positive changes in the external market index. And watch this very carefully, guaranteed to never decrease due to market volatility. Have you guys noticed that our markets went down again today? We've had a lot of down days. Do you know that our clients have not lost $1 in this market? Not $1. We only make money when the market goes up, and we never, contractual guaranteed, can lose a penny when the market goes down. Pretty cool, huh? The power of indexing, folks. Here's your start at 100,000. Here's the S&P 500, right? Over a 17-year period, 170,000, pretty good. But our index strategy, the green, where would you rather be, the red or the green? My IUL strategy, 352, 271. Not one down year. Look at that. Where do you want to be, the red or the green? Warren Buffett, you recognize this man? He's known as maybe the best investor of all time. He's the CEO and founder of Berkshire Hathaway. He's, I think, the third or fourth richest man in the world, maybe top 5. I think he's worth roughly 70 or 80 billion dollars. Well, depending on how the market's doing anyway. But rule number 1 is never lose money. Rule number 2, don't forget about rule number 1. Only problem is Warren's been losing some money lately, but he's not losing it because he's probably not selling. So I'll give him credit for that. But just those rules, and I do have a lot of respect for him. He's solid. I think he's almost 90 years old right now. And that's his philosophy, and it has served him very, very well. Well, how can they guarantee? How can these insurance companies guarantee? So here's an example of a $1,000 monthly premium payment, $950 and then $50 bucket. The $950 goes into their general portfolio, which is fixed income, guaranteed fixed income. $50 will actually buy options on different indexes like the Standard & Poor 500 rather. So when there are gains, that's great. It gets credit to the account. If there's losses, it's a 0%. That's how the option works. So worst case scenario is that 1,000 will be worth 1,000 because it's conservatively managed by companies that manage hundreds of billions of dollars, in some case, several trillion dollars. Tax-free distributions. Your loans from the policy cash values are income tax-free. Distributions can be used for anything you choose, supplemental retirement funding, long-term care needs, college tuition. Remember that 529 where you had to put it in for college? Here, you don't have to. You can use it, but if the kids are not getting A's and B's, you tell your child, say, listen, you get A's and B's, mom and dad will pay for that. If you don't, I'm not. So you have flexibility. Or maybe your child goes in and gets a scholarship. The other thing I like here is any money that you have in your index policy doesn't count against your children being able to qualify for scholarships and grants. Fantastic. What about slip and fall? What about lawsuits? This money is safe money. Weddings, vacations, credit card, financial emergencies. Absolutely. IRS tax code. Anybody want to start reading those books? I know we have some accountants on the line that know the code very, very well. Can't tell you how many accountants I have as clients because they know this and they appreciate Section 7702. They appreciate the tax-free plan of an overfunded life insurance policy that is blessed by the IRS. It's in their own code. Life insurance death benefit, this is IRC Section 101, says that the death benefits receive federal income tax-free. And 7702, definition of life insurance, provides tax-deferred growth. And then 72E, loans taken from policy are not considered distribution and thus not generally subject to income tax. There you have it from income from the IRS. Now they're looking pretty good. Well, let's revisit that tax-free bucket, the IUL, tax-free. How much of that do you want in your portfolio? Do you have any of it in your portfolio? Number one, if you do have life policies, you may have whole life, variable life, you may have term. We will do a full review free of charge because you're a platinum member with the My $20 Business. We'll look that over and we'll see if there are superior plans right now that you can structure. It's kind of like, being in an automobile. You might be in an automobile for 10 years and maybe things are breaking down. You may have an old policy. Maybe time to get into a new vehicle that's a lot more efficient, that's giving you the accelerated benefits for disability, long-term care, terminal illness, being able to access the death benefit while you're still living, being able to access the money for your retirement, structuring it properly. Many advisors, and they may be doing it and not realizing it, is they structured it incorrectly. But it may not be too late to fix. So if you have these policies or anything like it, make sure to reach out to us and we'll do an analysis and see if we can do a life insurance rescue, an IRA rescue, be able to rescue your particular account right now from what's going on in the future. Those accounts may fail if they're not funded properly. I don't mean to scare you, but it's better to know early that your policy is not going to make it. Just like bringing your car to the auto shop and they're telling you if you don't do certain things, your car can get stuck in the road. I don't want to see your policies get stuck in the road. They may be underfunded or just the structure just may be improper. Here's an example, and we're getting close to our time, maybe another 5-10 minutes. And thank you for being patient, and I hope you're enjoying it. Richard and Grace Turner, age 46, years to retirement, 19, both employed, retirement age 66. Real life case scenario, here's your IUL. The IUL's in green, the mutual fund in red, and the blue, the principal payments. That would be putting extra payments into your mortgage, maybe overpaying it, extra payments. Both were contributing $7,500, rule of thumb. Put up to your company match. Less and less companies are even matching. And I would even argue here that even the match doesn't work out. And I can show you mathematically that it doesn't even make sense to participate in a 401k. And I'm going to say it, I'm going to be controversial, even if they're giving you 100% match. Mathematically, it just does not stack up. Redirect $10,000 or $15,000 pre-tax, contributing $7,000 a year, mutual fund, rule of thumb, have enough assets liquid for 6 to 12 months, emergency money. Rather than being taxed every year on gains, consider alternatives that grow tax deferred. Redirect this $7,000. Additional principal payments. In this case, the client was putting extra money, $3,000 a year, into their mortgage, but they had a very low interest rate of 4%. When they factored in the deduction, it was really 2.5%. So if we can beat that significantly and have the liquidity of the dollars, we encourage them not to do that. Redirect $3,000. And let's see what happened here. No lifestyle change or additional savings. And then we come up with a personal wealth report, which you're all entitled to receive. A personal wealth report, which will compare everything that you're doing to help you and your family make a great decision. As a platinum of the My $20 business, you're going to have this 20-page report with colors and graphs, and we'll walk you through it. It'll be like this, comparing the IUL, the green here, versus the taxable, which would be the mutual fund, the stock account versus the 401k, and versus the Roth IRA, because things are relative, right? It's like, well, this sounds good, but compared to what? So in this case, the client is saving $20,000 a year, and from age 47 to 65, starting at age 66, they're pulling out $65,000. And you can see that the money runs out on the taxable account. Remember, the biggest fear is running out of money in retirement. Well, at 74, the mutual fund ran out. The stock portfolio ran out. So at 74, can we say, well, can we get a do-over here, please? No, you don't get a do-over. These are serious decisions that are made. And some of the folks that are on this webinar that are a little older, I'm sure they're nodding their head saying, Bill's 100% right. So if you're in your 60s, 50s, certainly 40s, 30s, and 20s, hey, don't make the same mistakes that other people make. You don't want to have to run out of money here. I have so many people in their 70s, 80s, and even 90s said, boy, I wish I did this when I was in my 50s and 40s and 30s. Take the advice of some of these wise people. What about the tax deferred, the 401k? We had to take out $108,000 to equate to the $65,000. Why? The tax bracket. We had to net out 65, so we had to take out the 108. And then we ran out of money at 78. How does that feel? And what about the Roth IRA? Remember I told you that, yes, the Roth IRA can be very good, but it has a lot of limitations. If you're making too much money, they won't even let you put money in here. There are limitations. But what about the green, which we call a super Roth IRA? You don't need the Roth IRA. The Roth IRA doesn't give you the death benefit, doesn't give you the disability, the long-term care, those accelerated benefits, terminal illness, doesn't protect the money, doesn't give you exclusion for your kids. It doesn't give you lawsuit protection. Doesn't give you as much flexibility and liquidity. Why do I need the Roth IRA? I've got this superior with all the benefits, and I'm being responsible. So forget it. So the client, $380,000 total premium, $65,000 a year in tax-free distribution, tax-free death benefit, $998, almost $1 million. The wealthy have been using the strategy for over 100 years. Walt Disney, after failing in the pursuit of traditional means of financing to build what would become Disneyland, Walt decided to provide his own financing. Right? He is a visionary, and he had a vision here of developing Disneyland using money from his life insurance policy. And that's what he did. He leveraged it. J.C. Penney, the stock market crash of 1929, the ensuing Great Depression, devastated stores. J.C. Penney was able to borrow against his cash to help the company meet its payroll, be responsible, and day-to-day expenses, and move on and keep thriving. Jim Harbaugh, University of Michigan, helped Harbaugh become the top paid college football coach in the nation by creating a deferred compensation package utilizing cash value life insurance called Indexed Universal Life. Smart, very smart. Tonight's summary, here we are. 3 biggest risks during your retirement. Prepare for each one. Common retirement vehicles does not align with your wants. Number 1, tax minimization retirement vehicle. The IUL allows for tax diversification. And again, it must be properly structured by an expert that knows how to do it. You can't just go to anyone across the street and ask them to put this together for you. A specialist. If you have one, go to them and ask them to put it together for you, put a report like I've shown you. If you don't, come to the experts, reach out to us, we'll do it for you. You'll get a beautiful wealth report just like this. Access your current retirement savings plan, show you what an IUL could look like for your situation, analyze the associated costs and past performances. The wealth report like this, normally $295, we've even charged $500 to $1,000 for a report like this. But guess what we're going to charge you guys? You're platinum, right? Forget it. It's going to be free. The only thing that we ask is that you're serious about your money. We can't be more serious about your plan, more serious about your money than you. But if you're really serious about your money and you really want to improve, you contact us. We'll give you some gifts. We'll give you a free consultation, and we'll provide a free report for you because you're platinum with the My $20 business. And Steve Gresham said, no, we're not going to charge our platinums. We're going to give it to them for free. And Steve is the man. And I said, absolutely. We're going to have a video series that we will provide for you. When you reach out to us, we'll give you the code so you can see our video series from my team. You'll see a video from me and from some of my staff, which is spectacular. Give you the right education. You do that online. And again, that is free. We'll provide a consumer guide that we have put together, 3 types of money, debtor versus saver, how banks make money, the history of life insurance, frequently asked questions. I hope you guys are enjoying this webinar. We just wanted to stack it with value. We honor, we respect you. We love that you're here. When you complete the form, a customized personal wealth report, we're going to be able to provide some handouts for you guys, 14 educational wealth building videos, and then of course the consumer guide to proven wealth strategies as well. So you'll get all 3. Remember, I told you we're going to get gifts, 3 major gifts: the video series, the customer guide to proven wealth strategies, custom wealth report. There's no obligation to do business. Matter of fact, if you have people that can do a better job than we can and you feel comfortable, just go to them. Go to an advisor that specializes in this. But if you would like to get it right from the experts, reach out to us and we'll do our best to help you and your family. Well, I want to close here by saying David Walker, the U.S. former Comptroller General. This is the guy that audits all the finances. He even directs the Congress. This man did it for 10 years, from 1998 to 2008. He was elected to the CPA Hall of Fame. This is a very, very well-respected man in the know and knows exactly what's going on in the IRS. He knows exactly what's going on with our national debt. And he says we are headed to a future where we'll have to double federal taxes or cut federal spending by 60%. I'm going to say it again. David Walker, U.S. former Comptroller General. We are headed to a future where we'll have to double federal taxes, double. So if you're at 25%, maybe you'll be at 50. If you're at 35, you might be at 70, according to David Walker. So really think about where you're putting your money. Is it coming out taxable or tax-free when you need it most? David Walker. That's all I got, everyone. This is Bill Constain. There's my phone number. There's my email. Please email me at info@freedomwealthservices.com. I will connect you with one of my advisors. In some cases, I will work with you directly. If you have a specific need or request that you'd like to work with me directly and you're a platinum and you're a high net worth person or someone that is extremely ambitious, referred by Steve, I will work with you. But again, we're very interested in your financial future. This is the Mentors Club. This is Platinum Mentorship. No one has seen this the way I put it together. Matter of fact, Steve hasn't seen this particular slide yet. I know he's enjoying it. So action steps, right? Because knowledge is potential power. We got to put that knowledge into action. So if that all made sense, I want to see an email at info@freedomwealthservices.com. We will get those gifts out to you. And for the first 50 that respond tonight, I'll give you a mystery gift, a special mystery gift back when I respond to the email here. And I'll be responding, if not tonight, by tomorrow afternoon. It's a little late for me and I put my all in. I hope you guys really appreciated this. I did my best. I want to see you guys succeed. Keep building the My $20 business. Bless people's lives. Help people with their finances, with their cash flow. Having a home-based business, being able to save money on your taxes legally and ethically, being able to increase cash flow by saving money on things that you're buying already, an average of $5,000 a year, and then maybe another $3,000 to $5,000, or maybe $10,000 a year on your taxes. So maybe another $8,000 to $12,000 between savings and taxes. And again, on taxes, it's as long as you have an intention to make a profit. But that's a lot of money. You apply that money and get yourself out of debt and align with us in our mission, helping over 1 million families get out of debt and experience financial freedom. This is Bill Constain. Take action. Email me and I'll do my best to respond to you tonight or tomorrow. God bless you and your family, and we'll see you on the next video and next webinar.